This is Bazaar Morning Call. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, and this Friday morning we have Rima with us, and of course Nigel as well. Guys, hi, good morning.
Good morning.
Hi, good morning. It's a Friday and the earnings season has ended. It's just period.
Indeed, and it's been the last couple of good trading sessions for the bulls. So let's see whether or not we can end this Friday on a high note. But besides that, it's going to be the weekend, so really looking forward to that.
Biggest smile reserved for the last. All right, well, let us quickly kick things off and tell you what you need to know as we begin this Friday, right? And we find ourselves in a pretty good spot. For the last almost fortnight, actually more than that, 3 weeks or so, the market's been ranged. Not really, of course, before that there was a slight amount of pullback. But since then, it's been kind of with about 200 points up, 200 points down, not really going anywhere. And finally, it does look like over the last two sessions that the market is breaking out. So, for example, there's a downward sloping channel on the Nifty. Very near term, very short term. I mean, it's about, 7 or 8 days old. We've closed above it. That is kind of significant to note. I'll come to levels, etc., and address the question whether we're breaking out and we perhaps should look at all-time highs as the new level. But overnight, the handoff is pretty positive. So U.S. equities closed higher once again. And by the way, it's closing highs. The S&P, after a little bit of sort of shakeout post the CPI, is back at last Friday's closing levels. So the S&P was up about 0.6%. The Nasdaq was up about 1/3%. The U.S. 10-year, it still is very elevated. I mean, if you look at Friday to Friday gains, I think the U.S. 10-year would be up at least 15 basis points. And last night it was just a 1 basis point pullback, but 4.24, but flat. If you're looking at incremental day-on-day moves here. Dollar index was down meaningfully. I mean, that's nearly a 0.5% cut in the dollar index. So from knocking at 105 levels, we are back closer to 104 now. So that is a relief in that sense. You had data, the big data point, of course, was the CPI number earlier. And markets really got scared whether, this is, because this was not one-off. We had so much other strong data, and markets were starting to question whether the Fed essentially, rates will be high for the foreseeable future. Rate cuts will be pushed back further. January retail sales are weaker than expected. There is some weather-related element impact because the building materials sort of component within it, which is significant, slowed down. There was, and that was largely to do with the weather, as many have pointed out. But even then, X of that as well, these numbers are actually weaker. And this kind of sort of takes the heat off what I was talking about earlier, whether the U.S. economy is really overheated. At least, that was a narrative which was being built. It's just one data point. The big one, of course, is going to be the PCE, which is the Fed looks at very closely, perhaps more than anything else, but that is only, we'll get on the 29th of this month, towards the end of this month. Oil prices, they are back at about $83 a barrel, so that perhaps at the margin is a slight negative, so to speak. Now, in the very near term, I think we've been anyway treading water just a few percentage points under the all-time high. So, you perhaps get a line of sight for a retest of the highs at about 126. That's the previous level, not very far away. It's important, and I made this point over the last 2 days, and HDFC Bank, for example, after the lows at about 1350 has been showing signs of life. Yesterday was again 2% higher. It's important for large names like these to sustain and perhaps not come off, even if they don't participate too much on the upside, is to be steady and kind of build the base here because, they're large constituents in both the Nifty and the Bank Nifty. On the downside, if you want a negation level, that is 21,530, which the Nifty should not break. We put enough distance, some 400 points between that and where we closed yesterday. For the Bank Nifty, we closed above the 40-day exponential moving average and the 61.8% retracement as well. So here again, especially thanks to HDFC Bank, things look better. Resistance here comes in at 47,100, which is approximately 1,000 points out from where we are. And support for the Nifty Bank comes in around 45,645. So those are near-term, very short-term trading levels this Friday. I think the GIFT Nifty is indicating a higher start as we've seen over the last 2 days now, like clockwork. The gains, the GIFT Nifty shows a very large gain. At some point in the first 2-3 hours, you get a dip, markets actually flatlines, and that's been the time to actually dip in and buy if you're trading the index for gains over the next couple of days or so. Rima.
Hi, but broadly, the global market sentiment is upbeat. And you spoke about, the headline indices in US. Look at the Russell 2000. The Russell 2000 was up 2.5% yesterday. So globally also, the flavor in the market has been the mid and the small cap. It happened in the Indian markets. It's happening even in the US. Asia's broadly higher. So Nikkei, the Hang Seng, the Kospi, all of these markets have gains of about 0.7 to 0.9%. So in the green there, mainland Chinese markets continue to remain shut on account of the New Year holidays. In terms of flows yesterday, the DIIs net bought 2,276 crore, while the FIs were net sellers to the tune of 3,000 crore plus in the cash market. But there were two large block deals, which we'll talk about in greater detail. Vedanta promoters sold stake amounting to 1,700 crore rupees, while in Yes Bank, Carlyle sold stake of close to about 1,000 crore rupees. We've also got a new listing today, Entero Health. And this one has seen muted subscription, fairly large size, 1,600 crore in terms of an overall issue. It also included an offer for sale, but the overall subscription for this company was just 1.5 times, so a bit on the muted side.
Well, that's right, Rima. We'll watch out for that one. But, in terms of trade setup, overnight, the troika, so to call it, they're pretty much in favor of the bulls. The Brent crude prices were a little bit lower. The dollar index was a little bit softer. And the 10-year yield, well, that cooled off as well a little bit, come down closer to around the 4.25% odd mark. So the troika in favor of the bulls if you compare it with the previous trading session. Yesterday, we did see another bout of short covering that played out, and bulk of that was on the Nifty bank. So for the second session running, on the markets, texture on the whole, we have seen in the futures market, there is some short covering that played out, and that perfectly ties in with what the FIs did. They covered close to 7,000 short contracts odd. They continue to remain net short, with close to 64% of their positions on the short side. But if you look at it, in the last few sessions, the short positioning has come down. From around that 85,000 contracts odd, from 90,000 contracts, that's come down to around 75,000 contracts. So there is some short covering that's playing out. And the FIs, they have been covering their shorts. And we had mentioned this at the start of the series. The FIs are net short. They could get stumped on the wrong side. And at least till now, it's playing out perfectly according to the script. What else is happening? Let's look at the options data. The 21,900 call and 21,900 put, both of them are fairly active. So it appears there's a short straddle at play. What is that? You write the strike, the same strike on call as well as on the put side, and you pocket the premium. In this case, the premium is roughly around 320 to 350 rupees odd. So that's what you're pocketing. And the range you're looking at is 21,900 minus 350, 21,900 plus 350. So that's the broad range that some traders are playing for. It appears this strategy is at play. The stock that I'm looking at is Polycab. Yesterday in late trades, suddenly you saw the stock come to life. And in fact, it ended virtually at the high point of the day. So it was a big up move that we saw out there. And that up move was backed by a fair bit of delivery-based buying in yesterday's trading session. If you look at the delivery numbers, that looked pretty good. It was close to around 85,000 shares that got delivered yesterday. That compares with the average of around 50,000. So good delivery-based buying, fresh long build-up is what we saw in the futures market. And with that move that we saw in the final hour of trade, well, it crossed that 20 DMA as well. So the chart tells you the story. Can it move towards the 50 DMA? But in the near term, crossing that 20 DMA, well, that's something that looked pretty good towards the end of trade. So that's a stock that I'm looking at. We start off in the green, but as we have seen in the last few sessions, you don't buy the gap up. Maybe if you get a bit of a downtake, intraday dip, you look to get in that. But it appears the bulls, they want to take this market to fresh all-time highs, and they've been showing that at 21,500, they have considered it a bit of a base on the Nifty itself, guys.
Thank you. So far this week, the Nifty is up 0.6%, while the mid-cap index is down 0.1%. And the big gainer has been the CPSE stocks, the Nifty PSU banking and the Nifty CPSE index gaining more than 3% so far this week. Let's get to some equity calls then. Sanjeev Prasad of Kotak Institutional Equities says they find most sectors and stocks quite overvalued. He says the level of overvaluation increases in inverse order of market cap, quality and risk. The market seems happy to overpay for weak business models in a few cases and unsustainably high profitability in others, which highlights high levels of exuberance, only greed and low concerns about potential risk, no fear. He says they increase their weight on Axis Bank, HDFC Bank, State Bank of India, and they removed Canara Bank post the 78% rally seen in that stock in the last 6 months.
All right, well, trust Sanjeev to speak his mind. We'll get you some market, money market views as well. This is V. Lakshman at a federal bank who says that higher U.S. inflation print with sticky core inflation has pushed U.S. Treasury yields on dollar index to a 2-month high as it puts off hopes of an early rate cut. He says the USD INR continues to trade in a narrow range despite a data-heavy week with volatility reaching multi-year lows. He's anticipating the rupee to remain ranged between 82.82 to 83.18 in the next few sessions.
On the bonds, he says domestic bond yields inched higher after the January CPI at 5.1% was a long expected line. He says the US 10-year yield touched a high of 4.33% as a bigger than expected rise in inflation deferred rate cut expectations. He adds the coming sessions could see the 10-year benchmark bond yield in a range of 7 to 7.15%.
Well, we've got a lot of stock-specific action to track. We get to that in just a bit in our special Top 10 segment. For the time being, let's run you through the list. We're looking at Vedanta, Sudarshan Chemicals, Bilcon, BL Kashab, ONGC and Oil India. All of them will be reacting to positive news flow. On the flip side, you have UPL, Interglobe Aviation, Sterlite Tech, as well as Yes Bank. They'll be reacting to negative news flow.
All right, Mark Matthews is with us to run us through the global setup. He's, of course, with Bank Julius Baer and Company. Mark, great to have you with us here. Good morning. Thanks for your time. The market reacted in a violent fashion to the retail numbers in the US, big jump in yields, etc. But since then, I mean, I think some nerves have been soothed. I guess retail sales were weaker, continuing jobless claims were higher. So in that sense, soft in that as far as the data is concerned. What's your sense, Mark? What's the market grappling with? Is it just a question of when and how much as far as rate cuts go?
I don't think the market is so concerned about when anymore. We're past that now. We know that rates will come down because Jerome Powell said that so last month. He said that they're not going to wait for 2%, and many other Federal Reserve officials have said the same. And I find it very difficult to believe they could backtrack on that. There's no data that's come out to merit it. So the data is mixed. I mean, as you rightly said, the CPI number was hot, but the retail sales were cold, and that's actually kind of a nice balance. So in aggregate, I think the economy is not too hot, not too cold, which is where we want it to be. And the earnings have been good. So I'm not surprised the market is going up.
Mark, morning. What are the other big notable trends that you're observing in the emerging markets over the last 1 month?
The biggest thing is I think there's a bottom being put in place in the Chinese market, and it may be their economy starting to turn around because the data from the Chinese New Year holiday shows a big pickup over Chinese New Year last year. Expenditures are roughly double what they were. And so I think that the major thing is that China's putting in a bottom, and this dates back to the 22nd of January, where the Prime Minister said that they want to stabilize the market. It's up around 6% since then. My sense is that it's bottoming, and the next step could be for quite a sizable rally.
All right. Hi, Mark. Good morning. Good to see you. Mark, I was speaking to a fund manager here in India, and they were saying that, we can be very patriotic and say, thump the table and say India is doing much better than China. But otherwise, if you want to make money, maybe, some allocation to China at this level would be more wise. What's your view on that? Do you think incremental money that comes out to the emerging markets, will it start flowing towards China at these valuations? Yes, India is a structural story, but in the near term, will China outperform?
I can't actually answer because I think India has its own attributes. But if you just look back in history, it's very clear that the better market has been India. $100 invested in India 30 years ago would be about $1,800 today. $100 in China would be $150 today. So the magnitude between the two, the difference is extraordinary. And I think just speaks multiples about the different corporate sectors. Basically, the nature of the companies is very, very different. And so I think we can have a trade in China, but it's not a market I would own for the long term, though.
A beautiful example, Mark. I like the way you put that. So it appears that, China could get some allocation, but not at the cost of India, right?
No, it could get it at the cost of India, but I'm just thinking that longer term, India is still the one that will do much better. There are issues in the corporate sector in China that prevent it from basically having a stock market that does well over time.
Mark, there were all these headlines yesterday. This country in a technical recession, that country. I think there was UK, there was Japan, there was, I think, one more European country. What do you make of it?
I don't make much of it. I mean, a technical recession is 2 consecutive quarters of negative growth, but in both cases, the negative growth was so small, it's the same thing as zero or even slightly positive growth. And I don't think in either case it will be sustained beyond these 2 quarters. So I mean, they both are fairly low growth economies because they're so mature, but they're not about to dip back into some very deep and dangerous recession. It's an extremely mild one that actually could easily be taken away by revisions in subsequent months.
All right, Mark, we'll leave it there. It's a pleasure having you with us. As always, great speaking with you. Well, we'll take a quick commercial break here. A list of top stocks to watch out for with our research team lined up next. Stay with us.
Sir, is there a...
Welcome back. After closing with a 70-point gain yesterday and the Nifty above 21,900, this morning we've got positive global markets and the GIFT Nifty suggesting a higher start and above the 22,000 level. Mid-caps too outperformed yesterday, reversing some of the underperformance from the beginning of the week. But it's time now to talk about individual stocks. Our research team is standing by to kickstart the Friday's list. Nigel, on Vedanta?
Yeah, I'm looking at Vedanta. Yesterday, there was a large trade that took place, but it appeared that a part of that block got done because the street was bracing for a larger block. What we got at the end of the day was that, in fact, 6.5 crore shares, which equates to around 1.8% changed hands. And yes, the promoter entity was the seller. So they have a promoter entity in there, which is Finsider International, that held 4.4% stake in the company. Now, that will be trimmed by close to around 1.8%. The promoter entity on the whole has nearly around 63% odd. So that comes closer to around 60%. I read this development positively because you're always worried about the promoter entity and the debt that they have at Vedanta Resources. So they sold some stake, then they have some more liquidity, which is good news. And given that the free float, goes up since the promoter entity is holding comes down, well, you could see MSCI as well as FTSE see some kind of rebalancing on that. So foreign indices could see some kind of inflows out there. So that's why going with green. And yesterday the stock ended at the low point of the day, corrected from the high, but this is read positively.
Absolutely. So keep an eye out on that stock as we open up. UPL, I mean, the stock has been down in the dumps. Earnings were pretty weak. Outlook was weak. Debt levels, etc., had ballooned. And now, to top it all up, there is a rating downgrade as well. Vivek is here with more details. Vivek.
Well, good morning. Precisely because of the reasons you mentioned, number one, weak set of results. After that, a couple of analysts had pointed out that on the back of that, the company would have some issues, going ahead and servicing their debt. Debt to EBITDA has gone up quite significantly. And on the back of that, just prior to today, you also saw Moody's as well as S&P go ahead and downgrade their long-term ratings on UPL by a notch. Now, yesterday, what happened was that Fitch also joined the bandwagon. Fitch downgraded, UPL Corp's rating to a BB, from a BB positive to a BBB negative, and the outlook is uncertain. Now, what they're saying is that this downgrade follows a weak 9 months FY24 EBITDA on back of lower global crop industry demand. So what they're saying is that it's also on the back of the fact that the industry demand has been quite low. They're saying that UPL's total net debt to EBITDA could jump to 6 times at the end of FY24 versus just 3.6 times in FY23. However, over the next 3 years, they do expect the EBITDA to improve, but expect UPL to open in the red on the back of this particular rating downgrade.
Okay, the Fitch downgrade could hurt UPL today. I'm also watching for Interglobe Aviation because the DGCA has released the January passenger air traffic data. The overall industry growth stands at 5%. Now, Interglobe Aviation's January passenger air traffic growth stands at 16%. So it's outpaced the industry. But it's also what has to be kept in mind that peers like Air India have seen a much higher growth at close to about 39%. So despite an overall passenger growth of 16%, the market share of Interglobe Aviation has been coming down. In the month of January, it stands at 60.2%. But as you can see, it's been slowly sliding as peers, particularly Air India and Vistara, are gaining market share. Sterlite Tech is the other stock that I'm watching because CRISIL has revised the long-term rating to a rating watch with negative implications. Remember, Sterlite Tech too has been battling very high debt levels. Last quarter, in fact, the company reported an overall loss of about 49 crore rupees, and the company is looking to improve their cash flows and bring down their debt. But there is that CRISIL revising the long-term rating to a rating watch with negative implications for Sterlite.
We'll keep an eye out on both those too. But let's go across to Vivek, who's here to tell us about a couple of more stocks that he's tracking. Vivek.
Well, that's right. After Vedanta's block deal yesterday, you did see a couple of other important block deals happen as well. First was Yes Bank. The Carlyle Group yesterday trimmed its overall 6.4% stake by almost 1.36%. The entire block was lapped up by Morgan Stanley Asia. They bought close to 1% stake in the company. So that would be one stock on the radar. The second stock was Sudarshan Chemicals, one of the top gainers yesterday. HDFC Mutual Fund picked up over 2.5% stake in the company at 514 rupees a share. The promoter entities were the sellers, both Ajay Balkrishna Rati as well as Nisha Ajay Rati. Both of them sold a little over 2% in the company yesterday.
All right, Vivek, thank you very much for that. Well, more stocks with news flow. Upasana is standing by with that list. Upasana, good morning.
Good morning. First up is Dilip Bilcoin, where the company's JV is declared as a L1 bidder for a tender floated by Water Resources Departments of Madhya Pradesh. Well, the project mainly entails to the construction of irrigation and a dam project, and the project cost is nearly about 413 crores. Next up is BL Kashyap. The company has bagged a new order aggregating to 208 crores, and the order is placed by Manyata Promoters is for construction of mainly blocks at Embassy Manyata Business Park in Bangalore. With this order, the order book of the company stands at 3,165 crores. So we'll be watching out for these two stocks today.
Lovely. Thanks a lot for that, Upasana. Well, let's go across to Manisha. Manisha, your tracking crude oil prices is going to have an impact on ONGC and Oil India. Please go ahead.
Oh, well, absolutely. Overnight, we've seen nearly a percentage point or more of gain in the crude oil prices. This is after the dollar index slipped from its 3-month highs. Well, apart from that, the Middle East tensions continue to brew on and escalate in some areas, and that would continue to keep a premium on prices. We have seen a pivot point manage around $80 a barrel for the Brent crude oil prices. There also are the global growth demand estimates that have come in from 2024, while the IEA has it lower at 1.2, but OPEC expects 2.2 million barrels per day of a demand growth globally going forward in 2024. The markets also are watching out for statements from the Chicago Fed president suggesting that central banks should be wary of waiting too long before it cuts rates, and that also led to some pressure in the dollar. The retail sales decline for the month of January also has been supportive for buying. So overall, a good start for the crude oil prices, and markets do believe that this week could be a positive one as far as that one is concerned.
Okay, thank you for that. Here's a quick recap then of the top stocks. Stocks with positive news flow are Vedanta, Sudarshan Chemical, Dilip Bilcoin, BL Kashyap, ONGC and Oil India. Stocks with negative news flow are UPL, Interglobe Aviation, Sterlite Tech and Yes Bank. We will get into a short break on that note. On the other side, Siddharth Khemka will join in for some fundamental stock analysis. Later, we'll connect with Vikas Gupta of PG Electroplast to talk about their Q3 earnings. Stay tuned.
Welcome back. Hope you're having a fabulous morning. It's going to be a fantastic Friday, hopefully. And we'll be getting you all the stock market updates. For the time being, let's get straight to our first corporate on the show. We have PG Electroplast. That's a stock on our radar for Q3. They give a very strong growth on the top line. Margins as well, came a little bit lower actually on a year-on-year basis. Mr. Vikas Gupta, the MD operations at PG Electroplast, joins us on the show. Hi, Vikas. Good morning and always good to see you. Well, you're walking the talk, with regard to the numbers, and you're guiding for a very good showing in Q4 as well. So that's pretty good. But, I just want to ask you for FY25, what can an outlook will we look at? You're going to be doing roughly on 2,800 crores of revenues with margins in that 7.5%. What's the outlook?
Yeah, good morning, Nigel. And it's always a pleasure talking to you guys. For FY25, we are still not worked out the numbers, but definitely we will be looking at industry-leading growth in all our product categories, like air conditioners, washing machines, and television business. So we are hoping for a good growth in the FY25 also. We have not still worked out the exact numbers. We will be coming out with the guidance for FY25 maybe in a couple of months' time.
Got it. All right. So FY24 is looking good. FY25, we'll have to fix a date with you for that as well. Now, my query is on the TV business. I recall when we spoke last, I think this year you'll end with around 250-300 crores of revenues from the TV business. And next year you'll scale up big time. It could be 500 to 600 crores. I'm getting those numbers correct, I hope. Right?
So our target internally for television business for FY25 is almost around 500 crores, I would say.
Got it. All right. My query to you is, I'm looking at a note coming in from Incred, and they're saying good to see good growth on the top line, for the TV business. But they believe that it's going to be margin dilutive, and they've put out a few numbers. They're expecting margins to get diluted by around 130 basis points in the coming year, and in the next year by another 140 basis points. What do you have to say about this? Do you believe that margins will get diluted as TV scales up? And if yes, what could be the new range we should look at?
So please understand, when we talk about the television business or we talk about the other product category business, we cannot compare those businesses because those businesses have a very different margin profile. But if we look at the electronics business, then we need to see how the ROC and ROE will perform in that parameters. So that way, that business looks very promising. But nonetheless, on the whole, we are confident that we will be growing on our margin profile also in FY25 because we have the AC business and the washing business will be contributing a lot in that margin profile for
overall.
FY25.
Vikas, hi, good morning. Prashant here. I mean, world over, and this is true over the last 20-25 years, prices of consumer electronics, they go down, they don't go up, right? I mean, that's the general rule across product categories, and I think you'd agree with that. But just for this particular quarter, I think margins overall, not TV, but overall margins have come off a little bit. Is that, could you talk to us about, is that a change in mix or what caused it?
So please understand, definitely the electronics business has played a role in that. And as the electronic business has grown, so the margin has dipped a little in the quarter three. But if you look at overall, the guidance that we gave, we are doing better than the guidance that we gave initially.
So margins should, again, you said that you're working out numbers for FY25. But is it possible to sort of run us through what should be steady state margins? I mean, what broadly in the ballpark would be 7%, over 7%, under it?
So I think in FY25, we should be in the range of between 7.5% to 8% again.
7.5% to 8% will be the FY24 EBITDA margin. Just quickly on this Q4 guidance that you've given, a 1,075 crore on the top line. It compares with a revenue of 530 crore in Q3, so doubling on the revenue, and even on margins, EBITDA of 100 crore, which compares with Q3 EBITDA of 47 crore. While it's in line with your overall FY24 guidance, can you break it up, this Q4 guidance in the specific categories that you operate in?
So please understand, Rima, for us, the quarter 4 and quarter 1 are always a good quarters because that business, the AC is a the quarter 4 is always good for the AC business. So we have a strong order book, and we are already almost in the middle of the quarter 4, and the kind of run rate that we are running, we are confident that we should be able to achieve the numbers of 1075 crores in the terms of revenue and 100 crores in EBITDA for FY24.
Okay,
quarter 4 of FY24.
Got it. So you're sticking to the guidance of quarter 4. You'll get back to us with regard to FY25. And for FY25, more importantly, the margin that you have given us is 7.5% to 8%. You believe that will hold because of the evolving mix as well, despite TV growing. So we take that point. What about the IT products business? That as well is expected to grow, right? What kind of revenues will you be doing from there?
So for IT, we applied for a IT hardware PLI that is in our JV company, which is Goodworth Electronics with Jana Group. And we are already in discussions with certain clients. As soon as we are able to mature those discussions, we will be sharing those details and giving the revenue guidance as well on that.
Right. Vikas, would this be sort of this same as what you call component infrastructure, or this is separate? The IT products.
IT hardware, IT
is laptops,
hardware
etc.
covers the laptops. Laptops, computers, and servers.
No, because there's another sort of component. So there is now BI certification required, right, with for many things. And that is, I mean, of course, Chinese products can't have it, so imports there perhaps will get restricted. Is that an opportunity as well? And what kind of products are we looking at there when we talk about component infrastructure?
So please understand, like the main focus of the government is to deepen the component ecosystem in India, and that's why there are a lot of quality control orders coming out, where the government is trying to push the development of the local manufacturing base for the components. So definitely we will keep on evaluating that field also for the component manufacturing. But for us, our focus going forward.
Okay, I think we are losing that line. Vikas, are you there?
And IT hardly for the which servers.
Yeah. Okay.
Yeah.
Yeah.
Are you able to hear
we
me?
lost you there. Yeah. We lost you there for just a bit, but we got it. We got the answer. Sorry, what kind of components are these? Just to, you said you may look at it, but what are we talking about specifically?
Like if we look at the components, it can be like in our white goods PLI, we have motors, then compressors, and in the electronic components, there are like PCBs and all those things. So we will be evaluating those opportunities going forward.
All right, we'll leave it there, Vikas. Thank you very much. Good speaking with you and good luck. Appreciate you joining in here on CNBC TV18. I think that's the first corporate with sort of a quick comment on the earnings which are coming through. But back to markets.
Back to markets and back to stocks. Siddharth Khemka, head of retail research at Motilal Oswal Financial Services, now joins in. Siddharth, electronics manufacturing services, the opportunity is huge. The order book is swelling across, across the various players. Amongst the entire lot, you heard what PG Electroplast has to say. They're investing in their capex. They're guiding for a very strong Q4. Which one do you like in the EMS space and why?
Yeah, very good morning, Rima. Good to be on the show. So we think we are very positive on this entire EMS space. We see this as a multi-year structural positive story where India could emerge as a large manufacturing hub for electronic components, given the focus for Make in India, plus the focus on the government being very proactive in keeping a lot of items off the import list. So you have to make these products in India, and there's a huge consumer base in India for these electronic items. So it makes sense to increase the production base in India. You have a lot of different sub-segments within the EMS space. So you have the consumer durables, you have the telecom, you have the defense, the drones. So I think companies that we like among them are mostly well-diversified companies within this space. So our preferred pick there would be a Syrma SSG Tech, where we have a target price of 720, which gives a good, decent upside from current levels. Keynes is another stock from the space that we like. Cyient DLM, which has a subsidiary, a parentage from Cyient, is again another well-diversified company with presence across your electronics, defense, automotive space, which gives a good diversification to the company. And one small company from the EMS space which is Avalon Tech, that we like. We have a target of 610 there. Again, we see a good growth across this space of about 50% over the next 2 years, which justifies the current valuation, which is somewhere around 40 to 50 times.
Okay, all right. Hi, Sid. Morning. Good to see you in. What do you make of this entire metals rally? And in particular, I want to ask you about Vedanta. Vedanta, valuation-wise, is obviously the cheaper metal stock. Promoter entity has sold some stake, which isn't such a bad thing. The only fear is, does he have more to sell? Then that could be a bit of an overhang on the stock. But otherwise, it seems that they're getting their book in order. And Mr. Agarwal, you don't know what he's going to do next. But till now, at least, he's avoided any kind of default or anything on that front. Tell us more.
Yeah, Nigel, good morning. Happy to see you again. So if you look at the overall metal packs, I think the results have been pretty strong for the quarter, and the outlook again remains strong given the strong demand outlook, which is keeping the prices, the average selling prices pretty stable, and that is helping the metal companies report a better number. We had some of the others within the space giving out with good numbers. So even if you look at Vedanta, where it came out with very strong numbers for the quarter. The only problem is with the parent having such a large debt, which keeps on coming for maturity, and they need those cash flows. So we keep hearing from the management about some corporate development, the way they could unlock value or hive off some business to realize that money. So the Vedanta parent has loans in excess of 60,000 crores, which is roughly about $7.5 billion. And the dividends from Vedanta, despite Vedanta itself having a lot of debt, but the benefit of the upcycle in the metals has helped them. That covers only about 1.5 billion for cash flows for every year. And the calculation suggests that for next year, FY25, they would need somewhere in excess of 3.5 billion of repayments, which is what they are looking at from the stake sale that got announced or the media report suggested. So on the core, the business operations performance looks pretty strong. We also raised our estimates by about 15% for FY24 on back of these numbers. But looking at the overall corporate developments, I think we have a neutral rating on the stock with a target of 270 because these developments are unpredictable, very difficult to predict on that and how that will have an impact on the operating business.
All right. Siddharth, hi, good morning. PSUs, right, were once again top of mind, top of the leaderboard. So just want to put out these stocks. You know, actually, if you exclude M&M, which went up 7%, and we'll talk about M&M as well, the top 6-7 gainers on the Nifty were all public sector names. I mean, across a cohort of spaces. So BPCL, the price the chart from yesterday should come up. There was NTPC, BPCL up 5%. NTPC was up about another 3.5%. It's been a fabulous 2024 so far. ONGC went up sharply. Power Grid was another big winner. These are all nifty names, large names. SBI, of course, the leader there after the breakout that we saw late last week. And then there was Coal India, which was up about 4% as well. So, incredible moves here. We, of course, had Sandeep Tandon of Quant Mutual Fund. We'll play out some of the bites, etc. in a bit. But Siddharth, from this space at Motilal, from a coverage point of view, what are the top ideas?
Yeah, Prashant. So across various segments, we have been positive on some of these PSU names. PSU banks continue to be in focus, and given the good results that they have come out, NIMs have kind of pretty stable compared to the private banks where we saw larger NIM compression. So that is one positive for PSU banks where SBI continues to remain a preferred pick. But if you look beyond that, oil and gas space, we believe that upstream oil and gas companies, they are entering into a multi-year upcycle given the growth in the volumes, the capacity increase, and the stable crude oil prices, which are helping them. So ONGC and Oil India within that space is something that we like. Taking that forward for some of the oil transmission companies. So GAIL is another stock within the oil and gas space, which we believe could be the stock for the year 2024 and has been one of our top picks between that. Banks, oil and gas, power sector is another space which continues to do well. We have seen the strong power demand. The realizations have been pretty strong. Plant load factors have been good. And a lot of these utilities have ventured into the renewable space, which is kind of driving the valuations, the interest from a lot of these large international funds. So NTPC, Tata Power, these kind of stocks, they are also doing well. So I think if you round about based on these sub-sectors within the PSUs, they are reporting good numbers, valuations are comfortable, they are under-owned, and hence they're likely to continue to do well.
Siddharth, do stay on. We need to slip into a very short break. On the other side, Anuj Singhal will also join in for a quick trade setup. We'll also bring you the top stock picks for the day from our technical and F&O experts.
आपकी फेवरेट
Okay, welcome back. You're with us here on Bazaar Morning Call. There's 13 minutes to go for the pre-open session. Anuj is here this Friday morning with how he's looking at the market. Line of sight to a new high, Anuj?
Yes, indeed, Prashant. Good morning. In fact, since it's Friday, I've also chosen this line. The Nifty is looking so beautiful, so elegant, just like a wow. It's just that kind of price pattern for the Nifty. The last 2 days' price pattern has been extremely bullish. When you rally on bad news and from an important support level, the market's indication is very clear. It's going up. And that's what the Nifty has done over the last 2 days. It's possible to see an all-time high very soon, maybe today itself. If not today, then in the February series, the price pattern clearly telling you that. First signs of bottom formation in HDFC Bank. I think that's also important. The next lines would come up for yes. And big leadership visible in big stocks like SBI and Reliance as well. IT stocks could also resume their upward journey given what's happened over the last 2 days in the US market after that one-day decline. And the mid-cap index is also set for all-time high. So that, I think, has been the good thing for the market. Now, you know what? I'm going with some very interesting analysis that has come from Motilal Oswal for the Q3 earnings season. It's just come this morning. And, they're talking about the Q3 earnings being beyond expectations. All the earnings are out now. And that, I think, is phenomenal because there's been widespread outperformance, mainly due to margin tailwinds. Domestic cyclicals as well as like autos and financial, and global cyclicals like metals and oil and gas, they have done really good. And it's only the technology sector which has posted the first marginal decline in earnings in 26 quarters, but we know that. And the stock prices have moved on regardless. BFSI has clocked 22% year-on-year earnings growth, while the expectation was 17%. Autos, 60%, estimate was 34%. And metals, 74%, estimate was 25%. And we all worry about the oil marketing company stocks rallying. The profitability has surged 4.6 times. Forget about percentages. And the Nifty itself has delivered 17% earnings growth year-on-year versus an expectation of 11%. Now, when earnings grow 17%, obviously that means the market can also go up like that. 5 companies, of course, have delivered the bulk of the earnings, but net-net, the earnings season has been phenomenal. Now, of course, coming to the levels to watch on the Nifty, I think it's going to open above the resistance one of 21,953 to 21,964, and the next resistance is 22,053 to 22,126, the all-time high zone.
Okay, thank you very much for that. Sudarshan Sakhani and Prakash Gaba are with us now for a few technical trading ideas. Gentlemen, good morning. Sudarshan, starting with you. Do you see an extension of the rally that we had yesterday and this, outperformance of the mid-caps continue? What's, the setup telling you?
Good morning. The setup is telling us that the mid-caps are likely to outperform, but let's keep that aside. The Nifty itself, which is the benchmark index, chances are that it's going to make lifetime new highs in this month, February itself. Today, despite the market gap up that we are likely to see, this is a buying opportunity. Wait for some minor dips. Maybe we won't get large dips, but minor dips will be worth buying into. With an initial, the Nifty should first challenge 22,100 and a high that was made a few days ago, then eventually go across 22,200 to make lifetime new highs. So with the trend clearly up, the opportunity remains on the buy side. Bank Nifty is finally putting its act together. It's in a large trading range, but that trading range is giving signs of eventually breaking on the upside. So the Bank Nifty is a buy. It's not an intraday buy. You build a position today and wait for the next week to sort of pan out. So it is possible that a breakout should carry you much higher in the Bank Nifty also. Both indices are buying opportunities.
Got it. All right, Sudarshan, thanks for that. So we got a call on the index. But Prakash, how are you feeling today about the indices? Last couple of days have been beautiful. You expect us to see more follow-through?
Yeah, good morning, Nigel, and good morning to everyone. When I look at the Nifty and the Bank Nifty,
it gives me a feeling the trend is still intact up and has not been compromised. One. Number two, what we have seen is a sideways action is more of a time-wise correction and a slight price correction. So the uptrend continues. For today, I think 21,700, 21,750, these are buy zone. These are strong support zone. Given a breakout there. So if we get a flat open, it's buy. It's a dip, if it's buy. Now, if it gets a gap up open, then we may have to wait for a correction to buy. Or maybe it takes out the high of the first half. Possibly that's a good place to buy. But yes, it's a buy. Can it go up to 22,000, 22,100? Yes, certainly that's a possibility. I think Nifty is a buy. When I look at the Bank Nifty, exactly similar is the case here. 46,000, very, very strong support zone. Dips viable, flats viable. Possibly we'll see an up move here. Targets could be in the vicinity of 46,700. So Nifty and Bank Nifty, buy on dips or a flat open.
All right, about 500 points from here on the Nifty Bank. Gentlemen, good morning. Good to have both of you here. In terms of specific trades, Sudarshan, let's start with you. What do you have?
You were talking about PSUs earlier, and BEL is my, is on my list today. A small correction in BEL is over. The stock has started a rally, and that's with the Nifty. I think it'll probably touch 195 and cross it maybe. So buy with a stop under 180. The other trade is positional. It's L&T, Larsen & Toubro, where a significant decline may be coming to an end. Now we are trying to buy on a significant dip, which is not yet ending. But then good quality stocks are worth buying when they are a little available at lower prices. So L&T is a buying opportunity with a stop under 3,100. And finally, Tata Power, which had a sharp correction, found support at previous support zones, is a buy with a stop under 360.
Okay, Sudarshan, thanks a lot for that. So we've got your picks out of the way as well. Prakash, coming across to you. Prakash, I wanted your view on Polycab first up, and also if you could run us through your picks, because yesterday in the final hour of trade, suddenly Polycab did take off. So if any view out there, and then you could fill us in with your picks.
Well, as far as Polycab is concerned, it's formed a good base and is given a breakout as well at 4,400. And it's trading at 4,564. Can it go to 4,800? That's a possibility it can go there. But one needs to have a stop below 4,400. Because there's an issue on fundamentals on the stock. Let it be sorted out. But yes, a trading bet is available there. 4,800 would be the target. 4,400 is a stop. It's a deep stop. So quantities could be reduced, but one can trade Polycab on the long side. So it's a buy, of course. If it gets a dip, better it is. If not, stay away.
Okay, all right. What about your picks? Yes.
I like HDFC Bank. And one, I would like to disclose that HDFC Bank is my portfolio for a very, very long time since IPO. Here, technically, seen a good down move. Very strong support existed somewhere closer to 1368. That's a technical support. It's seen a low closer to 1363. And yesterday's move, once it crossed 1390, gave an initial signs of strength. It's in buy mode, trading at 413. I would have a stop of 13 rupees, 1400 rupees, that's it. And I have a target of 1450, 1460. But once it crosses 1460, HDFC Bank would have confirmed that it's a bottom down. It's not. So HDFC Bank is a buy. Even if you get dips, it's buy. Second stock that I like is Asian Paints. Formed a good base here, trading at 3015, has given initial breakout yesterday. I would have a stop of 3,000, so 19 rupees. Can it go to 3,100? I think it can go there. May take a day or two for that, but looks like Asian Paints formed a good base and it's moving up. The third stock that I like is ICICI General Insurance. Seen a massive strength out there. Some kind of a consolidation. It's in buy mode, trading at 1650 zones. I would have a stop below 1620, 30 rupees. And possibly we'll see a move to around 1700 or even higher in the days to come. It's in buy mode, tremendous strength out here. And finally, I have Alchem. Alchem looks like an indicator buy. He's given an initial buy signal here, trading at 5306. Possibly we'll have a move until 5,400 to 5,450 in the days to come. A stop below 5280 should be okay on Alchem.
All right. Interesting trades, interesting trading ideas. And that point about HDFC Bank is well taken. Not a recommendation or anything, but maybe the thing with things like HDFC Bank, which perhaps are taking time to form a base, bottom, etc., perhaps is like maybe a systematic way to do it, right? I mean, like a SIP in a stock. But not investment advice, but just kind of thoughts on what we're seeing there. 1414, low was about 1350 recently. Gentlemen, thanks very much, both of you, for joining us. We'll take a quick commercial break here. We'll come back with the pre-opening session. We'll also have Harshvardhan Dole of IIFL to talk about the third quarter earnings in the power sector. Stay tuned.
Welcome back to Open Exchange. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, let's get you some more derivative strategies. Sneha Sheth joins us this morning. Hi, Sneha. Good morning. Hope you're having a good Friday morning. It's been good for the markets. What is your strategy and what are the stocks you're looking at?
Good morning, Nigel. Yes, if you see market yesterday, it was trading in the tight range, but managed to close above 21,900. However, if you see on the higher side, 22,000, 22,100 is the resistance zone. So I would not recommend buying at this levels. Yes, but in case of any declines, we can go ahead and long Nifty. In individual counters, we are seeing decent moves. So we can, the focus should be on individual counters only at this moment. So I have a 2 buy call. Both have hit fresh record high yesterday. So the first one is Maruti. If you see, this counter has given a strong move from the 200-day simple moving average. And on the higher side, if you see the call options also, we are seeing recent build up in the higher strikes. So I think we can go ahead and buy 11,100 call option in the range of 170, 180. The stop loss can be maintained around 87 and the target expected is around 334. Apart from this, I'm also liking Cummins India. This counter has also given a strong move with volumes. So I would recommend buying 2,700 call option in the range of 43, 45. The stop loss can be maintained around 27 and the target expected is around 81.
All right. We'll leave it there. Thanks very much for that perspective, Sneha, and thanks for those trades as well as we look at things. Well, the market, the pre-open is coming up on your screens and it's a higher start, about 130 points higher is what you have. So we basically are, as we were discussing in the morning, clear line of sight to a new high, and we're going to open up very, very close to those levels. I mean, in any case, even after the correction, it was a few percentage points distance, and now it's looking even closer. Look at HDFC Bank, maybe if you can put that up, because it's been showing signs of life over the last couple of days after the recent low of 1340. It's up 0.5%, so 1421 on HDFC Bank. Maybe look at Paytm as well. That's the other one which has been going, it was down 5% yesterday as well. Take a look at that. It's down another 3%, so 315 on Paytm. More stocks, and we'll do a check in a few minutes now. Well, let's focus on the, oil and gas and power and utility space. The sector has been buzzing for no small reason, also because a lot of them are, many of them are in the PSU space. Harshvardhan Dole is Senior Vice President in Institutional Equities at IIFL. He's with us right now. Harsh, great to have you with us here. Good morning. Thanks for your time. Prashant this side. How much of this is the PSU rub-off effect, and how much is it actual sort of underlying fundamentals? It's slightly on the lighter side, but maybe there's a ring of truth to it. Harsh, the stock performance we are seeing.
Hi, Prashant. Good morning. Prashant, last week we put out a detailed note on the power sector, and the theme was don't miss forest for the bushes. And the underlying theme was the whole power sector has entered into a massive mega capex cycle, which will span perhaps for more than a decade. And were that the case, stakeholders across the chain will significantly benefit. And there will be multi-year cycle in terms of earnings upgrades, leading to secular growth for some and cyclical growth for some of the stakeholders. And looks like the theme is playing out fairly well. And as might case be in most of the times, some stocks might price in the growth upfront and then they will consolidate, while some will take some time to re-rate. So in general, we are fairly bullish, regardless whether it is a PSU or whether it is private utility. We are quite bullish on the whole space.
And Harsh, when you say a decade-long upcycle, we are, to be sure, because renewables in any case is the big focus, we're talking about coal, thermal. That's the upcycle, right?
coal, renewable, all put together, I think there is going to be massive investments across the capacity.
No, specifically coal, Harsh. How much of that?
Yes.
You know, I remember the power minister, Mr. R.K. saying I think it was a month and a half, 2 months back, at a conference in Delhi, he had said we need, I don't remember exactly now, I think, but he said some 40 gigawatts of additional new thermal capacity, which needs to be built.
It's 88,000 megawatt. So in fact, we were also pleasantly surprised that the government has, sooner realized that India needs a lot of thermal capacity as well. And they are kind of nudging all the PSUs as well as the private sector to kickstart investments in coal-based assets. There is a call to put out 88,000 megawatt of capacity over the next decade. And that's assuming 500 gigawatt of renewable comes in. If there is a delay in terms of adding renewable capacities or pump storage hydros or essentially battery storage hydro system, I think the reliance on thermal power will also go up. So to that extent, to us, 88,000 megawatt is a base case number.
So that is 88 gigawatt. So, I mean, I'm widely off. I said 40. But Harsh, so when you buy something like a NTPC, is it a bet on thermal capex? Because typically that's how you would think. But they've got a large renewable portfolio which they're building out aggressively as well. So what are we playing for?
Well, NTPC are playing for both thermal as well as renewable because over the next decade, NTPC is in the base case set to double its capacity by adding thermal as well as renewable capacity. So if your capacity is compounding at 7 to 10% per annum, earnings typically will compound much more than that. So it's a play on both coal as well as renewables to me.
Harsh, morning. Can you put the valuations of these companies in context? NTPC, Torrent Power, Power Grid, what they stand at today and what the historical level is, and why one should be comfortable with the fact that today they are trading higher than historical levels. So just put in context the valuations today and how one should approach and look at these valuations.
Well, there's no denying that some stocks, even on FY25 and FY26, if one were to make a buying case, may not offer you returns which are more than cost of equity maybe over the next year or so. But that's typically the case. For example, let's take NTPC. At 80 rupees, it was trading at 0.5 to a book and a dividend yield which was double digits. Now the valuations are nearing 2-time book and the dividend yield has compressed to say 4.5%. Well, is this a reason to sell the stock? In my opinion, no. Probably stock will consolidate here, maybe for next 6-8 months, and then resume the upward trajectory here on. Same is the case with maybe Power Grid, which is trading probably a shade more than 2-time book, and Torrent, which seemingly is the most expensive in terms of price to earning multiple and continues to surprise in terms of earnings, may consolidate here for maybe 6-8 months, only to resume the upward trajectory thereafter.
So here and now, what does one buy?
I think from a sectoral perspective, NTPC is our top pick, followed by Power Grid and Torrent Power. These three are the names that we like the most. If somebody is willing to, bear in volatility, I think Tata Power also offers a good, bet. Probably a 10-15% correction in the stock price, and you're looking at a formidable renewable play in the sector. But yes, the stock will tend to be fairly volatile, and it's not for somebody who's looking for an annuity return.
Yeah, fair enough. But those, Power Grid and the other ones, you were saying that could go into a consolidation for 6-8 months, right? And then resume because they've already done so well. Got that. Just a quick word on BHEL. 30 seconds, Harsh. I mean, a lot of, some believe it's even in the wildest possible, whatever you build in, it can't justify where it's trading at. And there are others who say, well, there's more here.
Prashant, to qualify, I don't cover BHEL, but looks like, the stock has been doing well based on the PSU order flow. And if that were to be the benchmark, I think there is far more to come in terms of order flow.
You do cover oil marketing companies. Is there more upside?
I think there is best is yet to come. If the oil remains anywhere between 75 and 85, there is going to be spate of earnings upgrade over the next 12 to 18 months, and the multiples thereafter will look seemingly cheap. So BPCL, IOCL continue to be the most preferred picks in our sector. We strongly reiterate buy.
Thank you. for joining in. It's 9:10 now. It's time to get in Sudarshan's call for the day. Sudarshan.
Well, I think Tata Power is a buying opportunity. Keep a stop under 360.
Tata Power. Nimesh, what is your standout brokerage report for the day?
Hi, Rima. So, today's standout is on PSU banks. Looks like the upgrades are going to pour in. And today, BofA has upgraded a couple of PSU bank stocks. The first one is SBI. There they've upgraded to neutral. They've raised the target price in SBI to 800 now versus 690 earlier. They've also upgraded Bank of India to buy now. And there they've raised the target price to 300 rupees. They maintain a buy on Canara Bank, but there they've raised the target price to 660 now versus 540. And while they have an underweight rating on PNB, even in PNB, BofA has raised the target price now to 90 rupees. Now, the key reason for the upgrade, one, they believe that Q3 was another beat and a raise quarter. On back of that, they've raised the EPS estimates across the PSU bank stocks by 3 to 12%, and they expect on the back of better loan growth as well as credit card expectations. Now, while all the PSU banks now interestingly have converged to one-time price to book after the recent up move, and a lot of the technical factors are already priced in. But they believe that the FI positioning, there is a room for further upside once the investors see strong execution over the next 1 to 3 years. So a big upgrade on SBI as well as in Bank of India from BofA Securities. However, they've raised the target price on all the PSU bank stocks today.
Okay, thank you very much for that. Let's also go across now to Sudarshan for some brokerage notes for the morning. Sudarshan.
Yeah, so like all the other PSU companies, oil marketing companies too have seen a huge run recently. So Jeffrey has written on oil marketing companies. It has upgraded BPCL to buy from underperform, and target is raised to 890 from rupees 415 per share. It says BPCL offers largest margin of safety amongst all three oil marketing companies. It has a hold call on IOC and underperform on HPCL. As per Jeffries, key risks are rise in crude price, narrowing discount on Russian crude, intervening in retail pricing, increase in excise duties, and any large capex. Next is Citi on NMDC. It has downgraded to sell from buy. Target is raised to 215 per share. It says domestic price is at export parity. It does not see much room volume upside beyond FY25, and China's policy support has been underwhelming. Last is UBS on Amber Enterprises. It has downgraded to neutral and target is at rupees 4,200 per share. It says AC business is struggling, but electronics may add value over time. Weak results were driven by challenges in the AC segment, and stock is currently trading at 48 times, which is slightly higher than its long-term average.
Okay, all right. Thanks a lot for that, Sudarshan. Well, I think there are a couple of notes that have come in on Gujarat Gas as well. So, we should get that up for you on the screen as we speak. I think, a couple of notes came in earlier today, guys. Do any of you have that note that is coming in there? Wait one minute. Let me just pull up a couple of notes that we have. Jeffries, they have gone ahead. I think they've raised their target price out there to around 470 rupees. So they continue to have an underperform rating out there. It was an operationally weak quarter with the EBITDA in line, but the volumes are 4% below what Jeffries was working with on further market share loss in Morbi. So that explains why they're, they have an underperformed rating out there. And pricing strategy suggests that margin difference over gaining back market share in Morbi. So that's another point. CLSA, they as well have a sell rating with a target price of around 360 rupees. They say that the past quarter was disappointing performance and there was muted commentary as well out there. And the PAT as well came in lower because of lower margins out there. So those are the couple of, and they also say that the management has guided for 10% volume growth and a unit EBITDA margin of around 4.5 to around 5.5 per unit. That's per SCM. And they find the multiple at around 30 times PE unsustainable. And that's why they also see that there are further risks to the EPS. So that explains why a couple of brokerages not too optimistic on Gujarat Gas.
Okay, awaiting the market opening, just a few seconds left, 5 seconds for the bell to go. The markets closed up above 21,900 yesterday, and the start is likely to be in the green. The Nifty's opened above 22,000. It's straight away off the bat, a gain of close to about 90 points. Sensex is higher by nearly 300 points. Mid-caps are moving in step with the frontliners. The mid-cap index is up close to about 0.5%, hovering around 22,000, give or take a couple of points. On the gaining side, you've got oil marketing companies. BPCL, which got an upgrade today, is the top gainer. M&M continues to see buying. Yesterday, it rallied 7%. Despite Q3 numbers being in line, analysts are bullish about the UV volumes for M&M and M&M. The buying continues. Tata Motors is giving it company on the way up in the auto pack. You've got Infosys, Wipro also higher in trade. ICICI Bank is seeing some gain at the start of trade, and HDFC Bank continues with its gains from yesterday, and HDFC Bank has clocked in a 0.5% open. On the losing side, ONGC is your top loser. That's down nearly about 2%. Axis Bank continues to see correction from yesterday. So Axis Bank is down nearly 0.5%. UPL, where there was that Fitch downgrade on its rating, UPL is a bit subdued in trade. But all in all, it's a pretty good start to the week. The Nifty is holding on to a 100-point gain now.
22,000 on the Nifty. That's the big headline this morning. So the bulls, they're driving home the advantage. A couple of sessions ago, we went down to around 21,530 when the US market sold off. And from there, you've seen a 450-point rally. Stocks in focus today. Gujarat Gas, that's down closer around 5%. We're telling you that brokerages not too optimistic post the past quarter's numbers, and that's why they're remaining a little bit skeptical on the prospects going ahead. They're losing market share as well, and at around 30 times, well, the stock is not very, very cheap. So that explains why that stock is down. Torrent Power as well, down closer around 1.5%. What's doing well? Glenmark Pharma is up closer around 5%. I think the con call details were fairly impressive, so that's why that stock is bucking the trend. You have NBCC is up close on 4.5%. Remember, we have the management that joined us, just yesterday, and they are talking about doing revenues of around 13,000 crores in the next fiscal, and in the next 5 years, they're talking about 25,000 crores of revenues with PAT of around 1,250. So explains why that stock as well is moving in early trade. A couple of other notable movers. Polycab. Yesterday, the stock ended at the high point of the day. Today, that one, in fact, is spiking up as well. It's up close to around 2%. So good move out there. Torrent Power is down close to around 2%. So it's a good-looking screen, one would say. You have close to around 6 stocks that are advancing for every 1 stock that's declining. So it's a fabulous-looking screen. I think MRPL, after the big run we have seen, finally giving back some part of it, down 4%.
Absolutely. Overall, though, it's a near triple-digit gain, right? 100 points. 22,008 is where we have opened at in terms of the gains. Now, just a few other names which should come up on your screen. Irida is up 4%. It's a top volume sort of led gainer. We were just talking about oil marketing companies with Harsh. It's BPCL comes up with a 4% pop, 677. And I think we had Nimesh highlighting that Jeffries note as well.
The target price is 890. What Jeffries has put on BPCL, 890. And they say amongst the oil marketing companies, this one offers the largest margin of safety.
Yeah, absolutely. But, the thing which caught my eye is not the price target, but where they're coming from. I think it's
underperform.
No, I think the last price target was under 500.
Okay.
So they're jumping from 500 to...
And it's a double upgrade, right? Underperform straight away to a buy.
Yeah. All right. Well, Bank of India is up 3.5%, 147, 148. Large volumes, third or fourth largest volume traded gainer. Rain Industries, I think we mentioned, 6.5% higher. It's a big volume-led pop on Rain Industries. AG's is up 6.5%. It was a big mover yesterday as well. I think we mentioned names like Dilip Bilkon, etc. Glenmark is coming up with a 4.5% gain. So that's a large one. 848 on Glenmark. There is Bharat Dynamics, which is up 3%. Data Patterns. Nimesh was highlighting that perhaps there's going to be a block. 8% higher on Data Patterns. Almost $2,000 coming through on that one. There is HPL Electric. It's been a fabulous week for HPL Electric. It's up 20% this week. Of course, 8% today. Inox Wind and Inox India both were up 10% yesterday. Inox Wind is coming up with another 4% this morning. And Jyoti CNC, we had the management with us yesterday, 4% again. Again, it's a big week for Jyoti CNC, which has done phenomenally well. There is EPAC, which is up about 7% as well this morning. BL Kashyap, there was that order, started about 8% higher. It's cooled off. It's got about 4% right now at this point in time. On the downside, nothing. Gujarat Gas, Nigel highlighted. MRPL, we've highlighted. But big volume-led large price decline? Not really. There's 1.5%, 2% kind of cuts, and we can talk about that as we go on. Paytm is down about 1.75% at this stage. We're at about 319 on that one. Amish Shah is head of India research at Bank of America Securities. He's with us here on the program to take some questions. Amish, good morning. Great to see you back on the channel. Appreciate your time. Prashant this side. So we've been sort of treading water just under earlier highs. No real meaningful shake-off or correction at all. There was a fortnight short-lived correction in January, and then maybe this mid-cap one-day kind of sell-off that we saw earlier. But beyond that, not very much. How are things looking, Amish? Is it up and away? Because now we are heading closer to the general elections as well. And recent opinion polls, etc., show that Prime Minister Modi and the BJP and the NDA alliance is in pretty top shape.
Sure. Good morning, Prashant. Thanks for having me. Look, if I were to talk for the year as a whole, we do think that Nifty will continue to do well. As you know, our target for the whole year for Nifty is around 23,000. In the base case, we do think that in the best case, it could even go to 24,500. So there is upside. In the near term, I think markets may consolidate because there is rising risk of accelerating inflation in the US. That pushes out the view on the Fed rate cuts that one had earlier. And a relatively muted third quarter earnings, I would argue.
Amish, morning. Rima here. Today, the BofA research team has put out a note on PSU banks where you've upgraded State Bank of India and Bank of India. You go on to say that, the valuations are converging to just 1 to price to book, pricing in a cyclical improvement, and there's room for FI positioning in PSU banks to go up. So tell us, when you try and talk to the FIs about PSU banks, and hitherto they've stayed away from most of the PSUs at large, what is now the opinion amongst the FIs, and how much could they go out and buy, and can it be at the expense of private sector banks?
It looks like, because first of all, there was a massive ROE differential between the private banks and the PSU banks. And as a result, there was a massive valuation differential between the two as well. But as the ROE differential is now shrinking, the view is that PSU banks' valuation should start expanding and converging to some extent with the private sector banks. And operationally as well, as we all know, PSU banks and PSU PAC in general has been improving on an operational front, so that deserves, this rally to continue. So specifically on the PSU banks, we think OPEX now is going to, OPEX run rate is not going to grow as fast. They do have a pretty strong liability franchise. They will probably be able to gain a reasonable market share from CASA. Valuations, as I said, are relatively still at a discount to private sector banks. And as a result, we think that rally can continue.
Okay, all right. Hi, Amish. Good morning, and good to see you in as always. What are you making of these other, the clutch of stocks that are doing very, very well? The OMCs, the oil and gas stocks. Someone would say that re-rating is taking place. The way those stocks have moved is a bazooka move. What's your view on them from here on?
Yes, Nigel, we are not in general positive on the PSU rally as a whole. We think that, one should look at it more on a bottom-up basis. So the power, steel, and the energy pack of the PSU rally is something that we are not comfortable with. You mentioned the energy stocks within that. But at the same time, we do think that the PSU banks, some stocks on a bottom-up basis linked to defense or railways, that those are the pockets of opportunities within PSUs that we are more excited about.
Yeah, no, absolutely got that. Amish, just a quick word on, many have said this, and I'm sure you've heard it from investors on the buy side, etc. as well, that the real bull market and the way to capture the growth story, the infrastructure spend, the capex spend, is via smaller companies, not the big giant conglomerates, etc. To that end, Amish, from in your coverage universe, and what are the best sort of plays there? What kind of companies? What kind of names? I'm talking about the slightly longer term here.
So Prashant, see, look, first of all, as we've discussed in the past, clearly capex cycle is going to be here for long. We've been arguing for 10 years of capex upcycle. We are currently only in the third year of it. So from a long-term perspective, there is genuinely earnings upside or ROE multiple expansion. So these sectors are typical deep cyclical sectors, and as a result, the delta that you see in terms of growth is meaningful. In terms of how should we evaluate as stocks, I think we have created 4 baskets. So we are calling them as product companies, companies that do EPC contracts, so project companies, the asset owners, and the indirect beneficiaries in terms of whether it is loan growth for banks or it's steel or cement demand for those sectors. So that's a pretty wide spectrum on how we can play that. You are right that the delta of growth will be higher for the mid cap and the small cap companies. Not all of them we are bullish anymore, given the kind of valuation expansion that we've seen in that sector. But I would argue that even the large cap EPC companies or even the cement companies or even some of the banks which are more wholesale focused, even they are not as expensive if you're really trying to play this from a long-term perspective. So it's a pretty wide spectrum, and I would argue that several sectors and stocks will benefit on the back of the capex-led upcycle that we're talking about.
So you like large cap EPC, some of the cement names, some PSU banks. What else, Amish? What else do you like? And you also said that, some of the mid caps now are unattractive because of the valuations. It's also important to know what to avoid. So tell us, what is it that you don't like now?
So, again, as I said that, I unfortunately, because I can't talk stocks, but, generalizing it, while the thematic in defense and railways, for instance, is for real, we think that, in the here and now, valuations have clearly gone much ahead of expectations. So they are pricing in like 3, 4, 5 years of growth already. And while I'm a believer in the capex cycle, execution is a different ball game altogether, and one will have to, execution is not always perfect. So I think the stocks are not discounting for that as of now. So let's say as an example, some of the automation companies, if I were to assume that the cycle goes on till 2030, and if I were to throw in the best case working capital estimates, the best case margins, the best case order flow growth that they can get, and then assume that 2030 is the end of the cycle, so their valuation comes back to the normalized levels versus the peak valuations or peak cycle valuations. We are basically saying that from here until 2030, these stocks now have only a 50% upside left. So 50% upside over a 7-year period is around 7% CAGR returns, which is something that you can generate out of a government bond, which is very safe. So is the risk reward now worth it? Is the debate. And then as a result, I think what the markets are basically doing is that they are trying to get that entire 50%, which is due in the next 7 years upfront, and which is the worry that I'm talking about. That yes, that upside is justified, but it is too soon that we are seeing in these stocks, which is the discomfort that we have.
So that's broadly on railways and defense. Are there any other sectors or themes or pockets where markets have front-loaded all the gains? And there is that execution risk?
Yeah, I think the power generation, power transmission, companies as well. I would probably put in a few of the automation stocks within that as well. We've been downgrading a lot of stocks within the mid and small cap, coverage within the capex theme, despite being so bullish on the capex cycle overall.
Okay, all right. Amish, China's been in disarray, so to call it, and data points are not, looking good from there. But I think some part of the street is a little bit optimistic that maybe they have hit a trough and things will improve from here on. If that's the case, then metal demand will improve. And that's why, even though there are risks to Q4 numbers for some of these metal stocks, but most of them have seen a big surge. How are y'all playing this entire metals theme? Do you all believe there's scope to move up? And if yes, what do you like, ferrous and non-ferrous?
So Nigel, unfortunately, we are yet not a believer of the big pickup in the economic recovery of China. So in fact, as we know, one third of the Chinese steel demand is from China real estate, which is not something that we think will improve in a hurry. And as a result, steel as a basket is not generally what we are positive on. The non-ferrous is relatively what we prefer at this point.
Lovely. All right, Amish, thanks so much for joining in and filling us in with all of those details. Wishing you a good Friday ahead and look forward to having a chat with you rather soon.
Same to you.
Let's Let's focus on JK Cement. That's the next corporate on our show. The quarter three numbers look very, very good. Sales volumes as well did surge up. And they've also announced capacity expansion. Mr. Anuj Khandelwal, the business head, joins us on the show. Hi, Anuj. Good morning. Thanks so much for joining in. Well, tell us, how is demand on ground? If you could tell us ahead of the election, how do you normally see? Do you see things slow down a little bit? Is construction activity as good as expected? And what does that mean in volume targets for this year as well as next year?
Hi, Nigel. Firstly, thanks for having me on this segment. And yes, look, the demand for the full year per se till now has been really great for the industry, right? The overall industry has grown at double digits. But in Q4, we are seeing slight slowdown from the lofty levels we've seen earlier this year. So we'll still, expect the industry to grow around 5% or so in Q4. Q3 was also in the similar levels. What we believe is maybe in the second part of the next financial year, we'll again see huge growth coming back after the electoral activities have concluded. But overall, still, I would say from an overall year perspective, it's quite a fantastic year from a cement demand outlook.
Okay, all right. And for this year, the volumes that you are targeting, I think grey cement was around 16.5 million tons. And overall cement, you were looking at around 18.5 million tons. Is that a fair estimate?
Yes, that's right. So on grey cement perspective, we are targeting around, let's say, near 16.5 million tons as we had guided. And overall, on a consolidated volumes basis, we'll end up somewhere around 18.5 to 19 million, which will still be, let's say, a good 16-17% growth versus the previous financial year.
The problem is the challenge is on a high base, how much can you grow? So if you're expecting the second half of the year to look good, then what kind of a growth can you expect on this high base? Point number one on volumes. And the EBITDA per ton, what is the outlook on that front as well from year on? I recall when you joined us last in November, you were saying the second half of the year will be much better. And your past quarter actually was very good. So what is the rough range we should work with?
Okay, so let me first take up your point on the volumes. Yes, of course, we have had good volume growths over the last 3 to 4 years, but we are confident of a good volume growth in FY24, FY25 also, which is the next financial year, because we have also new capacities coming up in Prayagraj, and the capacity which has just got commissioned, Ujjain, will also, give us more volume leverage. So overall, we still believe that, maybe we'll be able to clock a healthy volume growth next year in spite of a relatively slow start to the market in the first half of the next year. So maybe around 8 to 10% growth, we'll definitely, try to target. As far as volume, as far as EBITDA goes, yes, last quarter was really good. Overall, look, we had a target of 1,000 rupee per ton on a consolidated basis for this year. On a YTD basis, we are running at 1,080 rupee per ton or so. So we are, targeting to end the full financial year FY24 around that levels, 1,080 to 1,090 rupee per ton, which will still be a good 90 to 100 rupee per ton greater than what we had internally targeted.
Okay, that's good to know on the EBITDA per ton. What about, the volumes on the premium sales? What would that number stand at for this year and even for next year as you look to target an 8-10% kind of a volume growth?
Yeah, so premium sales, as I had covered in the last segment also, we are right now at 12% of sales. That's how our premium sales is. We are taking very conscious steps on, how to increase premium product. Next year, we'll be targeting to touch 14-15% on premium sales.
Also, since we're on the topic of, volume growth, I want to touch upon your capex plans. You've laid out a strategy to hit 30 million tons, I think by 2030. Will you look at an acquisition in the... You want to hit 30 million tons by 2030, right? That's your capex plan.
No, that's not right. Look, we are at 22.2 million right now with 2 more million tons in Prayagraj coming up by July. So it'll be 24 million by June 24. And by March 2026, we'll touch 30 million. Because with the expansions which have been approved by the board, and assuming the construction time which will take to make those expansions live, we'll touch 30 million by March 26.
by March 26. And so there is no acquisition plan for the next 2 to 3 years.
So look, our base plans are always organic growth, because you really can't plan for an inorganic opportunity. They come when they come. However, if there are some opportunistic, if there are some opportunities which come by our way, we continuously do evaluate. But our base plans are always through organic growth.
I know the couple of plans that are on the block, Anuj, which I can't, name them. And I think y'all as well, being a large player, would be aware of them. Couple of big players on the West Coast. In the South, there are quite a couple of players as well that could be looking at selling out. If you'll have to go for inorganic growth, let's just assume that, hypothetically, what would you all be willing to pay for that?
It's a very, I would say, hypothetical question. It's a lot of conjectures are there, so I would not hazard a guess. But yes, look, opportunities, valuation of an opportunity depends on a lot of things, the existing capacities, the potential to expand, etc. So it's very difficult to put a dollar per ton number to an opportunity. But as I said, we firmly believe our base growth plans are organic growth. So inorganic growths are once, if some opportunity comes up, we'll have a look, but that's not what our main focus is.
Interesting. You're setting up capacity at $60, $70, $60, $65 per ton.
Exactly.
That's why I just thought that if you have to go and pay, I don't know whether you'll be willing to pay more than that.
No, look, conceptually speaking, inorganic growth opportunities gives you faster time to market as well. So,
yes,
of course, there's a bit of premium to that. But, you are absolutely right that our greenfield or brownfield expansions happen at a much lesser rate, the rates which you kind of mentioned. And we have a good track record of evacuating the capacity fast. So we believe in our ability to evacuate the opportunities fast, and hence shrink the time to market which takes place when you go for an organic opportunity.
Got it. Anuj, let's add some color to this interview then. The paint segment, that's a very small part of your business, but you're optimistic on the prospects. I think for this year so far, you've done around 120 crores and it's still loss-making. By FY25, say towards this second half, do you see this business turn around? Point number one, will it be profitable? And second part is, on the top line, what kind of a number can we look at? I assume this year you end at around 150 crores or maybe a little bit more than that. What do you end next year with?
So Nigel, I don't look at the paints business per se, but maybe I can still throw color, as you said. This year has been a fantastic start. As you said, we've crossed triple-digit mark, and more importantly, there is a good acceptance from the channel and customers in the geographies which we sell. I won't say that we'll in a way turn around the business, because the business is so nascent that it's the losses which you in a way mentioned are some startup costs. It's not essentially that the operations are not doing well. It's just the amount of investment which you need when you start a business. So, but maybe in maybe 18 to 24 months, we'll start getting to EBITDA positive there. But more importantly, right now we want to grow the business, because the business right now, it's just started. We've made first few strides there. So our main focus is to first grow the business and then look at profitability there. But I would still want to say that we've committed in a way an investment number, including loss funding, to the board and the investors. We are sticking with that. We are very disciplined about it.
Okay, but right now the focus is on growth and not profitability. That can be on hold for the next 18 to 20 months. Just one final question, since we spoke about capex. What would your peak debt number be? Are you looking to raise some more debt? And how will you fund that capex? Is there any fundraise on the horizon?
Oh yes, it is, because look, we are doing with the approvals for 6 million ton expansion, which came up in the later part of January, which is last month. We will spend around 2,800 to 2,850 crores on the expansion. So out of which somewhere around 1,000 odd crores will come from internal accruals and 1,850 crores will come from debt over a 2-year period. The way we look at it is that we want to maintain a healthy net debt to EBITDA ratio, which is around 2, because that balances the need for growth while keeping the financial discipline in place. As of December, the net debt to EBITDA ratio for our company is 1.64. So we are well within the thresholds which we've kind of kept for ourselves, and we are at a comfortable level. So that ratio we would want to keep it below 2 even when we take up this debt.
All right, we'll leave it there. Thank you very much for joining us, and it's a pleasure having you with us here, sir, on CNBC TV18. Appreciate it. Well, that is J.K. Cement with commentary on the business. We'll, look at the market, which is up 100 points. So 22,011 is where we're at. We'll take a break. We're back with the management of Finolex Industries. We talk about the third quarter performance. A little later after that, we'll also have the management of Zen Technologies to talk about their earnings. Stay tuned. Back, the market's up pretty solid. 100 points on the Nifty is what we have. But as promised, we have the next management waiting by. Finolex Industries reported numbers. And third quarter was weak. I mean, revenues were lower and volumes were kind of subdued as well. So let's understand what has happened. Mr. Ajit Venkatraman is Managing Director at Finolex Industries. He's joining us right now to take some questions. Ajit, good morning. Great to have you with us here on CNBC TV18. Prashant this side. So can we start there? I mean, was it start with volumes, basically? Is it lower offtake from a particular segment? Is it higher competitive intensity? What happened?
So towards the end of the second quarter, we started seeing slowdown of volumes, especially from the agri segment. And that was essentially driven by the negative sentiments for PVC prices. So that continued well into the third quarter, and that resulted in a drop in volumes in the third quarter. Whereas in the non-agri segment, we did do a fairly decent growth of over 15%.
And in agri, how is the fourth quarter panning out now? Has it picked up or is it still? Yeah.
Once the PVC prices stabilized around mid-December, the volumes have started picking up. And so far, it has been normal in the fourth quarter.
So for the full year, could you talk to us about what kind of volumes you will do?
So we are looking at anywhere between around 10% growth in the total overall volume.
FY24 volumes over 23?
FY24.
Okay, and because, we're also getting into the election season, etc. So does that have any implication one way or the other?
So far, it has been holding on. And we need to see how the month of March goes, which is much closer to the election year. So at this point of time, the volume seems to be normal as predicted. But we have to wait and see for the month of March.
Okay. That's on the volume front. Agri volumes are weak, but for the full year, given the strength in the other segments, you're still likely to clock a double-digit volume growth. What about on pricing? PVC prices have also been a bit volatile, under pressure. What happened in Q3 and what's the outlook on pricing?
See, since I think mid-September onwards, we had negative sentiments on the PVC prices itself. So we did see some amount of correction, and the prices have more or less stabilized around $780, $790 per metric ton for PVC. And that seems to have stabilized, and it continues as of today. So any stability in the PVC prices helps the market to cool down and also have confidence in pulling inventory into the network. So that is what we are seeing at the moment.
All right, hi sir. Good morning, Nigel on this side. A couple of quick details then. What is the current capacity, if you could tell us, in terms of pipes and fittings? What is your total capacity?
The total capacity is around 470,000 metric tons, both pipes and fittings put together.
And what is your utilization as of now?
So utilization is anywhere between 60 and 65%.
Got it. All right. I wanted to ask you whether some of your peers are growing at a faster clip as you are. That's what it appears so. Could you tell us whether or not you're losing market share? I'm just looking at a Supreme Industries, their numbers. It appears they're growing faster. Can you clarify on that? Are you losing market share?
So we have two segments. One is the agri segment and the non-agri segment. Good percentage of our sales comes from the agri segment, which has been a little bit slow in the third quarter, whereas the non-agri segment has been growing quite well. The mix, it all depends upon the mix. Our mix has resulted in the growth rate what we have seen.
Okay, so in both the two segments, if I split it up for you, what is your current mix, sir? Agri and non-agri?
About 65-35.
65-35. How do you see this mix changing going ahead? And in both these two segments, are you holding on to your market share as per your calculations?
See, we have been growing faster in the non-agri segment than the market. Agri segment is a little bit less predictable because it depends upon a whole lot of other factors as well. And therefore, and non-agri segment is mainly driven by the building construction industry. And therefore, we have been tracking that fairly well. Agri segment is influenced by rainfall, PVC prices, because that segment is price sensitive. And therefore, it has been less predictive. In terms of the movement, we would like to, the reason our focus is on improving the non-agri segment is to bring more stability to our performance.
And what's the contribution of agri and to your overall volumes?
So it's a 65-35 split.
Within that, are fittings doing better?
See, the fittings is, as non-agri segment grows, the fitting performance grows because there are more fittings needed for the non-agri segment.
Okay. So without getting into very specifics, could you tell us as we look into the next year, FY25, would the growth in non-agri continue to remain significantly ahead of agri?
We expect because the building construction industry is expected to grow at about 15%, 13 to 15%. And the CAGR expected for the next 5 years is that. And therefore, non-agri segment is going to be the growth segment.
So for Finolex, is there a ballpark kind of internal target? How much would you like to grow? And what can you do to make that happen?
We expect the industry to grow anywhere between 10 and 15%. And we expect us to do that as well.
Between 10 and 15%?
That's right.
Growth in volumes, essentially.
In volumes. It's the revenue in rupees crores is less predictable because that depends upon the PVC prices.
Give and take everything, sir. What about the margin outlook? That's come under quite a bit of pressure in the last few years. Given that pricing is stabilizing now, volumes could improve. Your mix as well, you've got it pretty much under control. What should the margin band look like in the next year?
See, as the mix has improved for us, improved in the sense as non-agri has contributed more to our overall performance, we have seen the margins improve. Right now, it is almost at a 10.5 rupees per kg mark. And as the non-agri contribution increases, the margins will increase.
Cash in the books is in excess of 1,500 crore rupees, Mr. Venkatraman?
That's right. That is
and
right.
How are you planning to utilize that? When is the board going to deliberate on perhaps a buyback or any kind of a special dividend? Because you keep generating cash and your annual capex is, I think, only about 150 crore rupees. So what's the plan on utilizing the cash?
We will be soon looking at expansion in the sense that in the next couple of years, looking at the growth, we will need additional capacity to be coming in. Just last year, we added 25% to our fitting capacity. In the coming years, we will need additional capacity in the pipes as well. So that is something which will take up a portion of the cash reserves. But yes, there will be more cash than what we need. and the board will decide whether to when to give it back to the shareholders.
But a few years down the line, right? Because you said capacity utilization is only about 65%.
65, and we need to plan for additional capacity, given that we are expecting the industry to grow anywhere between 10 and 15%.
All right, we'll leave it there, sir. Thank you very much for joining us, and appreciate your time here on CNBC TV18.
Thank you.
Thanks indeed for being here. Well, the markets, I think, come off a little bit, not much. About from 100 up, we're up 76, so just under. So 21,988 is where we find ourselves at. More sort of commentary on stocks, etc. in just a bit. But I think we have our next management waiting back here.
We do. It's Zen Technology. That's the next corporate. Q3 was a strong quarter for the company. The revenues went up 90%. EBITDA surged by 150%. And that led to an increase in the company's margins too, to 42.7%. Ashok Atluri, the chairman and managing director at the company, is now with us on the show. Thank you very much for joining in. Strong Q3 this year has been good for you. 9-month FY24 revenue growth is 142%. What can you end FY24 with? And can you give us an early indication of FY25 in terms of a top line? In the past, you had spoken of a revenue growth of 900 crore plus for FY25.
Yeah, so this year we had projected a target of 450 crores, and now I think we will achieve the target of 450 crores. And next year, based on the order book position, we have said it's going to be 900 crores. And we think that we still stick to that target, and we think that we will be able to achieve 900 crores.
Okay, all right. Hi, Mr. Atluri. I recall a couple of quarters ago when I was asking you whether you're going to get close to that 1,000 crore mark, you said you're not sure, but maybe it's a possibility. So now in FY25, it's going to be very, very close to that 1,000 crores. And FY26, I'm assuming, obviously, you get past that, going by the order book and going by the, the prospects for the business. But let's keep that aside. For the time being, we have these two numbers. My question to you is, what about the mix? Exports are expected to contribute more. So could you tell us how much will they contribute to both these two numbers, 900 as well as 450 crores? And is exports a better margin business?
I think, the first question is, I think it's going to be in the ratio of, 70-30 or 65-35. The exports will be on the lower percentage. And the margins are better in exports usually, because, what our way of approaching any customer is, we want to give them at the most competitive price in the world. And typically our pricing is a little dependent on what kind of competition do we have. So, yes, but, because of foreign manufacturers who compete with us, foreign vendors, their prices are much, much higher. And so we have an advantage there. And of course, because of the extra work that we need to do for an export, including installation, remote maintenance, etc., we have a higher margin there.
Got it. That clears it out. Earlier the story was more about a simulator, and now suddenly the anti-drone picture as well has picked up pace. What is the, how do you see both these two contributing going ahead? And is there a margin difference between the two? If yes, what is it?
So the margin is a little lower in the anti-drone segment and higher in the simulator. And the percentage split of the order book currently is, about 56-57 to simulator and about 43% to anti-drone systems.
Right. Mr. Atluri, sorry, you said 75% is?
65.
Sorry, 65. What's the mix, sir?
65 to 70% is exports. That is exports, and around 30% is the domestic market is 70%. 30% is exports, and 56 and 57 and 53 is simulator and anti-drone system split.
Right. Okay. So just 2 points. One, can you tell us the kind of work that's coming your way now? Orders that you're coming your way. What's the quarterly run rate, or is it very lumpy and kind of tough to predict? So maybe annual stock taking would be better in terms of order inflow. And especially on anti-drones. A couple of years back, I remember when drones as a technology is not really spread wide and far, there was talk of trying to control the spread of drones and not sort of, because as a technology, it could be pretty disruptive. I think there was an initiative in the US, etc. as well. We've come a long way from there. Is drones as a technology, and of course then when you come in anti-drones, is it really taken off and we should not look back at those kind of things, or is there a chance that in the future we may see some controls, etc., come through? Because it's a global thing. How do you look at it?
So I think the drone market, there'll be the regulation will be there, very strong regulation. But very frankly, the bad actors will anyway get access to this, and they will act on us. So we have to do a balance between stifling the innovation that's happening in the drone segment versus regulating it. I think Indian government has done a fantastic job. They're very, very liberal as of now, and I think that should continue. And with enough checks in place to ensure that don't become threats. But again, these are all evolving. The drone is evolving. Now most of the anti-drone systems, you see, they are made for 2.4 gigahertz commercially available. But the fact is that your threats are not only for commercial bands, but they may be in other bands also, because I don't give a damn about the regulation. So the counter drone things are also evolving very fast. Then today has a solution that goes across not only commercial drone but all the other bands which the military wants. This kind of the cat and mouse game will keep going, where the bad actors will try to keep evolving the drones, and we have to keep evolving the counter drone technology.
I'm assuming that the bad actors, because you can do a lot of damage with commercial drones, and that's the risk, and that's where you in a way so far that's where the anti-drone technology comes in as well, right? But you're saying the military drones, etc.,
the commercial
which are more
drones
regulated.
in the sense that I'm referring. I'm referring to the bands in which they have to operate. There is a commercial band, the 2.5 gigahertz or whatever. That's the band they're allowed to operate by the regulators. But if I'm a bad actor, I don't give a damn about you got the point. I will do any band that I want. So that is where the threat comes from, and the counter threats have to be, counter technologies have to take care of those threats into account.
Right. You said you do expect strong regulations to come in. Is something imminent? Are discussions underway? Should we expect something soon?
No, there are no strong regulation. What I'm saying is the government is going for liberalization of all the regulation to ensure that the innovation is not stifled. But I think they are going to evolve to say that, how do they prevent the bad actors from actually hitting it? Okay. I am not privy to any new regulations being framed in this direction.
Okay. All right. Mr. Atluri, very quickly before we let you go, you're looking at some inorganic opportunities as well. Anything on the anvil? And if you could give us a rough ticket size?
Yeah, so what we are thinking is that there are about including international companies that we are looking at, and they are in different stages. And we have said that we would like to get only into technologies that are related to what we are doing, not completely unrelated kind of thing, which will build some kind of a synergy or give us entry into the adjacent markets. So yes, the ticket size could definitely vary. It could be in a very low figure to all the way up to a few hundreds of crores. So we are looking at this point in time, but our criteria has been this, that it should be a company that does R&D and IP owned, and we want to at least take a majority stake. And in fact, now we are looking at 100% acquisition, and maybe with a swap, with a cash payment or maybe little shares. So, but again, if they don't own the IP, we don't want to touch them.
Yeah. Sure. Any candidates which meet all your criteria, your requirements? Is there anything on the table right now? Can you close an acquisition in the next 6 months?
So it's a little premature, I think, little premature to talk about them. So, we'll definitely let you know as soon as we are, as soon as we come to any conclusion. But I think they are at different stages, and we think that this will be very well received by the shareholders as and when we announce them.
Got it. All right. There's a new listing as well, Entero Healthcare, opening a little bit down, closer around 2%. We'll chat with the management in the next 30 minutes or so. But that's the listing up for you on the screen.
All right. No, I just, sorry, the listing which is coming through. I just one last question, maybe we can slip into for Mr. Alturi. Mr. Alturi, these the conflicts we have in the Middle East and the Ukraine and Russia, is that a large driver of export sales for you right now?
What has happened was, first Armenia and Azerbaijan happened, where they used drones extensively, Azerbaijan to win over Armenia, at least get an edge. And then the Ukraine war happened, where extensively they kept using the thing. And, even in Ukraine war, you see that, Ukraine has been gifted the world's most advanced equipment, but they still don't have an edge. And somebody said, if with that equipment, you can win a third world war, but they are not able because they're not trained. They have the best equipment. They are not trained. In fact, the fact that there is equipment they are being attacked and they're not using the equipment. So the training and the simulation part has become very important. And even in the Middle East conflict, we see that, people with hand gliders actually take over a country that is said, we are Iron Dome protected, most secure nation in the world. For 6 hours, they're completely control the sub part of the country. So you see that, if the training has become very, very important all over the world. They have started saying it's not the equipment, but training and simulation that is important. And the second thing they are worried about it, that they are not now the way sword fighting evolved to gunfighting, the same tectonic shift has happened in terms of drones being used. And there is hardly any counter drone technology available. Sure. And so these are the 2 points. Training and counter drone technology are the biggest point. And fortunately, Zen is exactly at the sweet spot that we are offering the solution. You're absolutely right. At this point, there is a high awareness and a high request that we are getting to equip the different nations, our Indian-friendly nations, with adequate training and counter-drone technology.
Got it. Mr. Alturi, we'll leave it there. I like the poster behind you. Think training is hard, try losing. Appreciate you joining in, and it's a great conversation as always. Thank you for joining us. Well, Prakash Gaba is with us with a quick check on how the market is doing. We're above 22,000 levels. Prakash, new highs, and what would you do in terms of trades?
Well, yes, good morning to you. Once again, Nifty looks okay, but it's a good trade only if it crosses today's high. Once that happens, we'll have a breakout. So far, because it's open with a gap up, so it could stay sideways. So far, it looks good. Bank Nifty is seeing some bounce from today's low. If today's low holds, there's a good trade here on Bank Nifty, and we can see an up move from here. I like 2 stocks here. One is Info Edge. Yes, it looks good. 5274, it's trading. One could have a stop below 5220. Just around 50 rupees. On the upside, the target could be 5,400. So Info Edge looks good, and perhaps we could see an up move there. Second stock that I like is MCX. I think given a breakout after a good base formation, trading at 3581, I would have a stop below 3525. Possibly we'll see an up move to around 3,750. So MCX also looks good to me.
Prakash, thank you very much for that. Auto is the top, index gainer right now. The Nifty Auto Index up 2%. And the top 3 Nifty gainers are auto names. Bajaj Auto, Tata Motors, Maruti, all rallying 2.5 to 3%. Get into a break. On the other side, Manisha will join in and put the focus on commodities.
Present.
Welcome back. Let's turn our attention now to commodities. Manisha is now joining in. Manisha.
Well, thank you so much for that. I'll talk about the sugar prices right now, because when you look at the last 1 week, we've seen the prices decline in the global markets, down by nearly 5%. But for the year until now, we still are nearly 10% on the higher side. And this is the quantum that the sugar prices put in the previous year, in 2023, when we closed the year 10% on the higher side. We've seen those kind of gains already happen in the first couple of months of this year. Well, this is how the sugar price trajectory really has been. We started the year with 20.9 cents a pound. We did see a gain up to 24.46. But it has been profit-taking since then, and currently we're trading at 22.9. So at these current levels as well, we are at a multi-week highs into the markets. We are trading at around 10% higher from where we opened into this year, clearly off the kind of highs that we saw into the year. The decline has come in because of the couple of factors here. One, when you look at the Brazil sugar output, that is higher by 11% as compared to previous year. But remember, those dynamics can change at any point in time. The reason you have higher sugar production from Brazil is because the crude oil prices are stable around that $80 a barrel mark. We've seen the prices trade within that 76 to 84 on the higher side. But as I said, that could change if the crude prices stay above 85 for a longer time. If we are headed towards that 90, then you will see lower sugar production and higher ethanol production coming in from Brazil. The other is the global consumption, which also is expected to rise on an year-on-year basis in this year. And much of that demand growth will come in from Indian markets, where the expectation is that you could be looking at a record 28.5 or even higher a million tons in sense of Indian demand for this year as well. So that would be supportive for sugar. Is the reason that you have India absolutely absent from sugar export as a market. You also have seen ethanol production or divergence being cut as well, because India needs more sugar into the country right now, and especially ahead of the election year as well. That's one thing that the street will watch out for. I also want to put numbers in sense of global deficit or surplus. So in the previous season, it was of 5 lakh tons of a surplus, but this year it's an anticipated 7 lakh tons of a deficit because of lower production in Thailand and India being absent from the market. And Brazil is going to be quite a tricky situation to be in, depending on where the crude prices go.
Manisha, thanks very much for that. So that's sugar in focus today. Well, Glenmark Pharma is the next one we're going to shine the spotlight on. Vivek has got more details on this one. He's back. Vivek.
Well, that's right. So what actually happened was that in Q3, Glenmark Pharma reported a surprise loss versus analyst expectations of a profit, and the management had alluded to the fact that there was a one-time hit. So in the con call, that happened at 8:30 a.m. today morning, the management gave more details on what exactly was the one-time hit. So the company went ahead and implemented changes as far as its distribution model was concerned and rationalized some channel inventories. So growth in the India business, ex of the one-time impact, was actually 9% on a year-on-year basis. Now, what they have said in terms of Q4, they will be back to their normal sales growth, and in fact they say that they would expect close to 1,000 crores a quarter as far as domestic sales are concerned. Along with that, they expect India to continue growth at the pace of 10 to 12% annually. Now, talking about the EBITDA growth, the company has clearly said that they expect a significant ramp down as far as R&D costs are concerned, to the tune of $45 to $50 million. So they expect that to aid the EBITDA. Also, they are expecting a significant ramp up in royalties, and they expect that that will be a big margin profile driver going ahead. And also, they expect operating leverage benefits to kick on. Along with that, they've given an update as to when exactly they expect the proceeds from the Glenmark Life Sciences deal. Remember, Glenmark sold Glenmark Life Sciences to the Nirma Group. So they are expecting to receive 5,600 crore from this particular stake sale, and they expect to be net cash positive by the end of this year itself. On the back of this positive commentary, stock is among the top F&O gainers today.
Thank you very much for that. The other big loser today is Gujarat Gas, post the Q3 numbers. Sudarshan joins in with the details. Sudarshan.
That's correct. So Gujarat Gas is under pressure after weak commentary in the analyst call. For FY25, the company has given muted volume growth guidance of 8 to 10%. In 9 months till now in FY24, company has done on an average volume of 9.20 MMSCMD. So for FY25, the addition is just in the range of 0.80 to 1 MMSCMD. That too will come from just one segment, that is CNG. Even on the earnings front, it was a miss. Revenue was at rupees 3,929 crore against pole of rupees 4,051 crore. Volumes were at 9.16 MMSCMD versus pole of 9.50 MMSCMD. Brokerages too are negative on the stock. Jefferies has an underperform call. Target is raised to 470 per share, but still 16% downside from current levels. It says volumes are impacted by further market share loss in Morbi. Volume growth guidance for FY25 is a dampener. CLSA has a sell call. Target is rupees 360 per share, which is nearly 40% downside from current levels. CLSA says management has guided for 10% volume growth and a unit EBITDA margin of rupees 4.50 to rupees 5.50 per SCM. On the valuations front, it says 30x P multiple is unsustainable and it sees risk of further EPS downgrades.
All right, Sudarshan, thanks very much for that. Stocks down big time, 5%. We'll take a quick commercial break here, but we'll come back and put the focus on the oil and gas space. We'll get chatting with someone who's run an oil marketing company, Mr. M.K. Surana, former chairman and managing director at HPCL. And we'll also have top analysts join in on the space. Prabal Sen is energy analyst at ICICI Securities. So trying to understand what's going on. Big moves in all these oil PSU names. Stay with us. Welcome back. 120 points higher on the Nifty is what we have. Let's talk about the oil and gas space. Upstream, downstream, standalone refiners. Everything has been doing fantastically well. Big rallies. And, the price move is forcing people who've stayed on the sidelines to change their view, participate. Analysts are, double upgrading things from, 500 rupees to 800 plus, like we've seen in the case, I think, of BPCL today, this morning. It's... the price dictates the mood, the sentiment. But fundamentally, what has really changed? That's what we want to understand. And to help us do that, we have Mr. M.K. Surana, former chairman and managing director at HPCL. He's run as big an organization as one can think of. And we also have Prabal Sen, who's a top energy analyst at ICICI Securities. Gentlemen, great to have both of you here. Thank you very much for your time. Mr. Surana, if I can start by asking you, sir, maybe a little tongue-in-cheek, but... one of the things which people say about PSUs, the logic to give by PSUs is that, they were highly inefficient. They've all become very efficient. As someone who's headed an organization of scale, do you think it's a bit of an exaggeration or you think it's true?
So good morning, Prashant. Let's see the question in two parts. One thing is probably people are used to paint everybody in the same brush. So there were PSUs were inefficient. There were PSUs which were efficient. The same case in the private sector also. But somehow the perception was that the private sectors are more efficient than public sectors. But having been in public sector, having worked for almost 40 years for public sectors, and having seen the public sectors functioning, I don't think that was entirely true. There were a lot of skill set available within PSU. In fact, many of the good private sector companies in the space where PSUs are made by the people who are ex-PSUs only. Even abroad, many of the multinationals are made by the people who are ex-HPCL, PPCL, IOC, ONGC. And therefore, as far as skill set concerned, that was never in doubt. PSU had been one of the best training grounds and the grooming grounds for the talents. One of the questions which used to be there was related to some processes, some procedures which used to hinder the decision-making process.
Yeah.
There is a change to that effect where there is more aggressiveness, there is more realization to the impact which decision create in the market. The people are more oriented to how their share prices move in the market, and market cap had been the performance parameter in the oil PSUs or the PSUs, which were not the case earlier. And the last part is after the listings have happened right from 92, HPCL was one of the first to get listed. Yeah. So over a period of time, substantial minority shareholders have come in, and so the demand of the stakeholders have also increased. That's one part of it. Yeah. And the second part is over a period, the PSUs have been more adept in accommodating the new processes, new procedures, new technologies, etc. etc. Yeah. And the management also, the newer generation as well as the older generation has become alike to like any other private sector. And I think these are some total of that which we are seeing as far as the efficiency is concerned.
Yeah.
But I still believe that people in PSU have been as efficient, as hardworking, as sincere, rather more loyal than in many cases than many of the private sectors. Not to say anything wrong about the private sector, they have their own skill sets.
No, absolutely.
Mr. Surana, so it is only being perceived now, it is getting demonstrated and it is being received well. I will put it.
No, absolutely. It's a very beautifully put. And my question was not at all about the skill set. I mean, absolutely take your point on, which is about processes, etc. And that point that you made about incentives, right? Much more attuned to share price, market cap. I mean, that is such a powerful shift, mind shift change, which I think has happened. Just one more specific point, Mr. Yeah, that is come through.
Technical orientation otherwise.
Absolutely. Mr. Surana, just one thing specifically. So, it used to be that most refineries here in India could not process, dirty crude, right? Only a few in the private space could process that, like the Jamnagar one, etc. Has that changed across OMCs? And
yes,
so that's also a fundamental change? Yeah.
Yes, to some extent, yes. Because if you remember earlier, most of the PSU refineries did not have the bottom upgradation facilities, but as in between the margin started getting under pressure, the need for deriving the best values from the bottom of the barrel kept on increasing. And a lot of the companies have put in facilities to upgrade their bottoms to more value-added products and the distillate yields. Okay. And that has led to many of the capex which has been put in last 5-10 years And those are getting fructified now to get much better product yields. And incidentally, it is also coinciding with the good margins on diesel and petrol. And that is so that is what is definitely added to the profitability of the PSUs. Added to that, the energy efficiency, because the fuel and loss factor, which remains one thing. When the energy efficiency comes, it has got twin impact. One is from the decarbonization part of the reducing the carbon footprints. At the same time, the economy of operation as well. And that is also added to the thing.
Got it. Let me get Prabal in. Points taken, Mr. Surana. Prabal, you heard Mr. Surana. To your mind, as an analyst, what are the top 2 or 3 reasons why we've seen such a big re-rating and why many believe that there are much more upsides?
So I think I hesitate to follow Mr. Surana, who explained the industry dynamics much more clearly than anybody else. But there are 3 reasons. One is that if you look at both oil and gas prices, the range at which they're operating right now, I think till about $85, $86 of crude until about $12 to $13 of LNG. It's a price band that the Indian consumer or consuming companies can actually work with in a very comfortable manner. As far as upstream is concerned, oil realizations anyways are capped at about $75, which is higher than what they've done in the last 8-9 years. So it doesn't matter much if crude goes to 80 or 85. And as far as OMCs are concerned, marketing margins, when the prices were last actually changed in a meaningful way, if you look at equivalent crude prices then, as long as crude remains below $85, you will continue to make reasonable marketing margins. Mr. Surana mentioned about the impact of the debottlenecking, the bottom upgradation, upgrades that have happened across the OMCs on the GRM capabilities of the OMCs, and the fact that that has coincided with a strong uptake in diesel, petrol, and ATF spreads, which, unlike in the Singapore benchmark, are actually about 65 to 68% of the product yield for Indian refiners. If you put that together, then both on the refining and marketing front, the prospects appear to be much more stable. Specifically for, let's say, a stock like HPCL, where refining capacities are also being expanded and they're also adding significant petrochemical capabilities. I think the earnings mix, visibility, and the scale of operations all actually is slated to, improve over the next 2 to 3 years. So there are tactical reasons which have led to an increase, plus there are structural reasons from a 2 to 3 year perspective that are both actually working in favor. Yes, there will be obviously dips depending on what kind of price cut is taken, whether before or after elections. Frankly, I don't want to get into that kind of prophesizing because that's meaningless. And, we'll have to look at what the margins are as a residual number. But what I would like to highlight is that even if you build in some sub $10 GRMs and about 3.5 rupees of marketing margins, even on that kind of bear case earnings, the stocks are still trading at a 50-55% discount to what the Nifty PE multiple is at, if you look at a 1 year forward direction, specifically for HPCL. I think that is a very, very important metric, that once the overhang or the perception, which seems to be going away, that there's a reason PSUs deserve to be trading at a 60% discount to everybody else, that seems to be going away. And I think that is one important metric, that's driving at least the PSU oil space over the last 6 months.
And HPCL presumably is your top pick, as you highlighted, I think. Prabal, so even if oil already is at about 83, Brent is at 83. So if it goes higher, say it goes to 90, you're saying there could be corrections, but the PE re-rating story is here to stay in that sense. That the perception that they need to trade at a vast discount, that is gone now. So that comfort is there, support will be there.
Yeah, I wouldn't go so far as to say that has gone, but I would say that, you can build in a reasonable discount for the fact that there is always going to be some regulatory interference. There are always more than just profitability as an objective, and rightly so for some of the oil and gas companies. But, if crude rises to $90, again, one will have to see what kind of mix happens between the GRMs and the marketing margins. See, one way to look at it is that what do you actually make up for every rupee per liter of retail margin loss, for example. HPCL today needs to make about $2.6 or so of incremental GRMs. What they are doing well in terms of expanding of Vizag capacity and then adding Rajasthan is that number will go down to $1.5, $1.6. So therefore, if crude rises and product prices also rise in the markets and GRMs therefore go well, even if you're not making that much money on marketing, your overall earnings may not get hurt. And I think that is a very significant change that is happening. So when we'll have to look at the balance rather than just look at an absolute crude level. Yes, if crude rises, sentimentally always one looks at marketing and says, it would probably create some bearish sentiments. But I think that looks to be changing, from a 2-3 year perspective.
No, got it. Mr. Surana, you're no longer running HPCL, and I'm not sure if you're investing. But if I were to ask you again, maybe an unfair question, what's the best company in this space from an investor point of view?
That will be incorrect for me to answer. But just 2 points I want to add to what Prabal said. The oil marketing companies or the oil companies always have an intrinsic value, but there used to be a risk perception against the thing in terms of the global dynamics and the government intervention, etc. During last 2-3 years, during the Corona time or during the Russian war or during the Middle East crisis, the way the crude supply portion has been handled and the policy decision has been taken and unequivocal stands have been taken, that is probably given, and during the Corona time, the way the whole thing has been happened as far as supply chain is concerned, the risk perception on the total commodity of oil has changed. That's what I think. And the people are perceiving it to be more resilient industry than what they used to do earlier. That's one point. The second point is that as such, because the market is going up, the value creation opportunities are limiting, and so some of the things which had the value but were not getting realized are getting realized now. That's the second thing. The third part which you asked, that which is better, it is incorrect for me to answer, but all the 3 companies have their own plus and minuses and have added strengths, especially depending on the capex which they have put in and the type of facility which the companies have put. And all 3 are integrating with petrochemicals and expanding the capacity and putting some facility to decarbonize and bottom. So I think there is a value. Depending on what capex and what is the timing of fructification of the capex, the value will get realized. And their HPCL is having an advantage because last 5 years capex which was being put, that is getting fructified now.
Absolutely. There's a great conversation and great points, Mr. Surana. Prabal and Mr. Surana, thank you very much for joining us. It's a short conversation, but I hope we can have you back, Mr. Surana, for a more detailed chat, because this is a theme, I think, which has got legs to run, as both of you would agree. Thank you very much for being here on the program. We'll wrap up on this edition of Bazaar. We'll take your leave. Thanks very much for staying with us. Market is up 130 points, almost at the day's highest point. Chartbusters is coming up next. It'll take all the action forward. Stay with us.
आज ऑफिस में